Good afternoon, everybody. I'm Stacy Scott. I'm the Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm also your host for today. First, I'd like to thank you all so much for joining us for this July Lunch and Learn. We host this monthly Lunch and Learn every Wednesday, last Wednesday of the month at noon, and we always appreciate those of you who choose to spend your lunch break with us and for giving us the chance to share some valuable information with you. For today's session, Graham is going to spend some time talking about total wealth management and how beneficial this approach is to managing what's truly important to you, especially during this current economic time. And as always, we'll have a few minutes set aside at the end of the webinar for a question and answer session. So if you happen to think of any questions throughout the presentation, please just type those into the Q&A section of the chat box, and we will get Graham to answer those for you. Also, you're going to see Graham's calendar pop up from time to time during the presentation. And if you want to schedule some time with him, please click on that calendar and select a time that works for you. And one more thing I'd like to remind you of is that if you've missed any of our past webinars or weekly wrap-ups, you can find those on our website. We have been loading some great content onto the website and also on social media such as Facebook and LinkedIn. So please take a moment and check that out. And now, without further ado, I'm going to turn things over to Graham to get things started.
Super. Thank you, Stacy. Hope everyone can hear me well, see me all right. I'm working outside of the office for this week, so we're on spot on my vacation, but I'm just glad to be here with you guys. You know, I wanted to spend some time today talking about wealth management, and it's a topic that's really close to my heart. Because we like to say we like to practice what we preach, right? So when we think about total wealth management, we're thinking about a holistic approach to managing what's important to you. So when we think about that, you know, like looking at one aspect of your financial lives, like investments or the retirement plan, those are one or two pieces, a part of your bigger picture, right? Because you're more than just one part, like investments or retirement planning, risk management. Now, I've already given you a couple steps that we think are a part of total wealth management, but we think there's 5 core steps a part of total wealth management. So in my presentation today, I'm going to break down each one of these parts of total wealth management and how it is being affected and how you should address that in today's current economic environment, because I think they pose additional responsibilities for you and some additional challenges, but I also think some really good opportunities. So I want to spend a little time talking about what we preach about and the effect in today's economy. So let's go ahead and move forward. And as you see, my calendar pops up. Just go ahead and hit that all along the way. So let's think about 5 steps to total wealth management. We have investments, tax strategies, retirement planning, estate planning, and risk management strategies. Now, these are 5 steps to address all aspects of your life, so not just one part of your life. So let's go ahead and break these down and talk about them in a little more detail with today's environment. So let's think about investments. Usually this the first component, but not first because it's the most important, just first because I got to it first. But think about it. This is probably the sizzle, if you might, not necessarily the steak. It's what people are excited about. It's about making money and earning money, and I get it. But it's important, but it's not the most important. I often say before you even get into these 5 steps or trying to think about retirement planning, you have to create a vision of what you're looking to accomplish. If it's retirement planning, what's your vision of your retirement? Every one of us has a unique vision. We need to see what that is for you. And then how are you going to address or check those boxes so you have a successful retirement? So let's get back to investments. So we think about investments, we've got some opportunities and challenges right now. We have what I call lazy money. We're in an extremely low interest environment. I think the 10-year yield is trading about 1.2% today, give or take. A little leeway there. You know, that was well in the 2% range, you know, and interest rates have been low and probably will stay low for a while. So what that means to you, if you have money sitting on the sidelines what we call lazy money, and that's okay. It's okay not to have all your money at risk with the markets and stocks or bonds. That's a part of your emergency funds, your savings, right? That you can't afford to take risk. Now let's think about it. If inflation, and I mentioned the 10-year treasury, but let's talk about inflation. Inflation pre-pandemic was roughly around 2.1%, but inflation is over 5% right now. So let's break this down into a 1-year return. If you're making 5% on your money and inflation is 5%, what did you make? You really didn't make anything, right? You're almost backing up now because you're going to be taxed on those earnings if they're outside the retirement account. So let's take it one step further and go a little deeper in this hole. Let's talk about your lazy money. So a lot of people with their ultra safe money might be only getting like or I said the 10-year yield is only getting 1.2%. So let's use 1 for round math. So let's say that, inflation is transitory and it's not 5. Because in that situation, you'd be in the whole 4% plus taxes. Well, let's go further and say, okay, let's say that some of this inflation is transitory and goes through the system, but some sticks, right? Because I think it will. When you give people raises, it's really hard to take it back. If you're an employer, you know what I mean. If you're an employee, you don't want someone to take back your raises. And they generally don't unless we're in bad economic times or the business is in challenge. But all that being said, let's say you got a 1% return on your very secure money, and inflation, let's say, moderates down to 3%, which is higher than the long-term average. You're still in the whole 2% plus taxes. So I think you get an idea of what I'm talking about. Be greedy in a very good way. I use that in the classes and courses that I teach. These are multi-day courses when we talk about lazy money or getting your money working hard for you. The other thing in investments is high equity and bond valuations. Now, I say that with a caveat. So let's think about this. When I'm talking about high equity valuations, the first thing that probably pops in your mind is, wow, all these indices are hitting highs. The Dow, the S&P, the NASDAQ, and you'd be absolutely right. But that doesn't necessarily mean that they're due for a massive correction. It doesn't necessarily mean that they're tremendously overvalued, because one thing that we need to think about is, what are earnings doing? So let's think about that. Now, I know it's a unique time last year, this year, and probably carry in to 2022 when we've got the reopening. We got animal spirits out there spending money, getting money, saving money, upgrading their homes, all this good stuff that we've been involved with or looking to do. And I know that equity prices are up, but think about it. Earnings are up. Earnings generally, in the middle of earnings season right now, earnings for companies are up on average about 2 to 5%, somewhere in that range, right? Do you know we're averaging right now over 18%, or roughly around 18% increase in earnings? That is massive. So as long as, and I do expect that to moderate, but as long as we see these earnings increasing and increasing, it is reasonable to have equity prices continue to move higher. Now, that doesn't mean you're not going to get these 5 or 10 or possibly 20% corrections. That's a part of just investing in the stock or bond market or whatever. You got to expect it, right? And plan accordingly. But as long as earnings are there, some stock prices, not all, can be justified. We were seeing massive earnings from the largest FANG tech companies right now, absolutely beating earnings, but not necessarily the stocks up very much. And that might be a reason that, the reason I'm pointing that out is because a lot of these stocks ran up, meaning moved up in stock value as they came out with earnings. So now it's confirmation of great earnings. And what's the old saying? You buy on the rumor and you sell on the fact. And you might be seeing some profit taking. And I don't disagree with that. You know what? There's also another saying in the market, and I'm full of these, trust me, is that, listen, you never go broke taking a profit. All right. So when we're talking about investments, higher equities, higher bond valuations, think about it. When interest rates go down, right, bond values go up. When interest rates go up, right, what happens to bond principal values, older bonds? They go down because newer bonds are issued with higher interest. Makes older bonds look less attractive. It's not always a one-to-one. It might be short or intermediate or long-term bonds are going to be affected different ways on what we call the yield curve or the curve. But think about it. Where are interest rates now? They've been coming straight down, right? Just coming down and down to spur on growth, to incentivize individuals and companies to spend money, to get loans. So you know what? We're seeing some of those bond values come down. Bond values go up right now as yields come down. But as we mature in this reopening, and we're maturing in this reopening, I think some of it, a lot of it will stay with us, meaning interest or inflation, earnings. But I think sooner than later, I don't know exactly when, no crystal ball here, but I think you're going to probably start to see yields move up. That's not necessarily a bad thing. And when I say yields move up, not just on the 10-year of the Treasury note, but from the Federal Reserve's Fed funds rate moving up, and that's the cost of borrowing. As that moves up, it's not necessarily a big negative, might be a little drama in the market, but actually the stock market and possibly the bond market can stand those interest rates moving up and stand a little normalized inflation, not at the level we're at right now. All right. So all that being said, I think interest rates are going to start creeping up. It's the pace of rates increasing, not that they are. Keep that in mind. So rates can move up slowly and steadily, justifiably, and stocks and bonds can do quite well, respectively. But if they start moving up really quick, and that can negatively affect stocks a lot and bonds and the like. Now let's get down to diversification allocation. Now, I think this is really important too when we're thinking about total wealth management within your investments. It's really important. Look at allocation diversification. Look what's happening to the Chinese stocks that are traded on the New York Stock Exchange or the US exchanges. It's nothing necessarily, and I'm speaking generically, wrong with those companies, but the government, the Chinese government, is stepping in, putting penalties and mandates on those, which are affecting those companies' ability to grow or maintain their viability in at least where they were trading or growing at. That is completely out of the company's control in many of these situations. So if you have large exposure in China-based companies that trade over here, you're seeing some world of hurt. I talked about it in the weekly wrap-up. I would say closer to 25 to 50% drops in some of these things. And it kind of trickles over, right? You have that effect that kind of moves into other areas. I don't think it's going to be systemic at this particular point, but it is affecting. Keep mindful of where your allocations are. Again, some of the things are just in your control. Some of the things aren't in your control. Doesn't mean they don't need to be managed and reviewed. Also, a lot of things have appreciated. The markets are up a lot. U.S. valuations are up a lot. International isn't up as much because of China and maybe the Delta, the COVID shutdowns or the lack of reopening because of the Delta variant overseas compared to the United States. So you want to look at your allocations and make adjustments, all right? I'm not asking you to be a trader, but you always want to view and adjust those. Moving forward, so the next step, we're going to look at tax strategies. You know, I think about it this way: is your legal obligation to pay less taxes. Now think about what I said, and this is what we talk about in class, and we spend a good section. So let's say number 2, a part of wealth management. Manage your taxes. Keep more of what you work so hard for, right? And it's all about avoiding but not evading taxes, right? Legally avoiding paying what you don't have to pay in taxes, but do not evade. Evade gets you in jail, avoid can lower your taxes, right? So you want to look at options. Look at your opportunities at your employer. Look at your opportunities with your IRAs or Roths outside. And we think about tax strategies in 3 buckets: tax now, tax later, and never tax. So let's think about that. Tax now. Tax now might be like your brokerage accounts, your accounts at a bank, right? So as you're earning, remember I was talking about lazy money earlier, those are going to be outside of your retirement account, maybe your emergency funds, maybe a brokerage account. Think about it. It's going to be taxed now, all right? You're going to get the 1099 at the end of the year or the next year. You look at tax later, all right? So think about it. What's going to be taxed? Social Security, pensions, your IRA distributions, because the government makes you take them at 72. It's called R&D distributions, and you have to take those out. The dollar amount goes up over time as your account value appreciates, and so does the percentage distribution that you have to. So think about it. Tax later, that's going to be your retirement plan at work, ex Roth. That's going to be your, like a 401k, 403b, 457 IRA. Taxed later, comes out as income when you pull it out by choice or by government regulation. Then we look at never taxed. Never taxed. What is an example? Let's say like a Roth account, right? If you hold it for 5 years from first contribution, you're over 59 and a half, you don't pay tax, right, on those earnings, all right? So you could think about, where am I positioning my money? Because I don't know where tax rates are going to be. I don't know what tax policies are going to be down the road. Is my income going to be higher down the road? Are exemptions, credits, and marginal tax rates going to be lower or higher down the road? Some of that's going to be higher. Some of it's going to be lower. So we want to be mindful of and diversify our portfolio within taxes. All right. Remember, avoid, never evade. All right. So tax now, tax later, never tax. Make sure they're proportionate based on anticipated objectives, income, time horizons. All right. Now let's go ahead and jump forward into retirement planning. And this is one thing that is certainly one area that we hold multi-day courses on. It is part of the total wealth management, not one component. And without a clear vision of your retirement, how can you plan for it? So we often tell our class members, if you've been to our class, you know what I mean, sit down, close your eyes for a second, and let's take a moment to just think about our vision of our retirement. Don't put a price tag on it. Don't put any of that. Just what does it look like? And then we can back into, okay, what do we need to do from a monetary standpoint to be able to fund that so we can live how we want to live in retirement, right? Because we don't want to think about living basically in retirement, but we want to thrive, right? So let's think about income analysis, all right? Where are you getting all your income streams from? Cash flow, what's coming and going. I think this one's really important, distribution needs. Okay, so think about this. How much additional income do you need from your savings in your retirement plans, your other investment properties and whatnot to supplement your retirement? Think about this. If inflation is 5%, right, and you make a 10% return, your net return is 5. You kind of follow me? And then if it's coming out of retirement accounts, you got to pay income taxes on that. You probably see exactly where I'm going at. Now you're going to get into what's called potentially a negative sequence of returns, or most importantly, where you're pulling from your principal and you're not allowing that money to grow back or you don't have the principal there to allow the accounts to grow or return back what you took out. All right. So when we think about negative sequence returns, these are interesting little one-pagers. If you want it, just text myself, my team, we'll get this little one-pager. It's a little case study between two couples, easy peasy stuff. But it broke it down and it said, listen, if you had a loss in the first year that you were taking money out of your investment accounts, right, to supplement your retirement, in that scenario, compared to a first-year distribution and a positive return for the account, the availability of you having money was reduced by 13 years. Think about it. If you're 65, the odds are you're going to live somewhere between 20, 25 years in retirement. 13 years is roughly 50% of that. That's huge, right? Then we want to think about too high of a distribution rate, right? How much are you taking out? And is the return in the account with inflation and the taxes that you have to pay justifiable? Listen, we can send you whatever money you want, but we're also going to tell you when you're taking out too much based on your risk tolerance, your comfort level, your goals and objectives, your time horizon, and the rate of return. So let's think about it. If you're getting a rate of return and you want to be really conservative, and I'm not saying there's anything wrong with it, we just got to understand and plan accordingly for that. Let's say it's 3%, and you have a distribution rate of 5%, right? We're eating into your principal by 2%. And again, I haven't even thrown in inflation and taxes on that if it's coming out of a retirement plan. So we want to make sure we bring that distribution rate down. The old rule of thumb used to be around 5%. If we're moving into a period in the markets outside of the reopening in this economy, that might be reverting to the mean, let's say adjusted returns in the markets might be about 7 instead of the rolling 10-year on the S&P is 15% of late. But let's say it does revert to 7. All right. And let's say you need a 5% distribution rate. That leaves you 2% to pay for taxes and inflation. All right. So 7 minus 5 your distribution leaves 2. Then we got to think about taxes and inflation. I think everyone's probably getting an idea where I'm going here. So these are all little things that are going to lead to a successful retirement, but they're a part of that bigger picture of wealth management. Again, any questions on anything I'm covering, because it seems like it never gives me enough time to cover all this stuff, hit my calendar, call my team, call me, and I'll spend more time. Let's talk about estate planning. Estate planning is really important. You know, I teach a multi-course retirement class, a multi-day class, about 6 hours long. It is certainly not buying you dinner and then talking to you for 45 minutes. This is very in-depth retirement planning based on the wealth management approach. And I often think one of the most important is estate planning. Because isn't it important? So think about estate planning from the standpoint is that you want to retain, you want to pass on to the ones and things you care about while you're alive and after you pass in the most efficient manner, correct? So let's say, unfortunately, life happens and you have a stroke and you don't have the capacity to make financial decisions like you did in the past. Well, you're going to need someone to help you out with that, right? Who is that going to be? We want to plan accordingly. So we want to be proactive, not reactive, right? And we're also looking at passing on. You know, if you've been in different marriages, if you have kids outside of your current marriage, or you move from a different state, you might want to think about, all right, if I pass, what are the tax laws, right? How is that going to affect my estate? And are my assets going to go to the ones and the things I love and care about when I can't make sure it's distributed to them? I hope that hits home a little bit because I think it's really, really important. We're talking about wills, possibly a trust. These are a part of proper estate planning. You do it while you're alive, not after you pass. And let's think about it. We're looking at the largest wealth transfer ever in history right now. I would be interested to see, and we're here after this pandemic, we don't have those numbers yet. What would that look for the future generation with all this wealth that's been created with real estate in the markets, assuming it holds up and we don't have some sort of collapse, which I don't expect. All right. But we're seeing the largest wealth transfer. So we need to think about that ahead of time. Think about while you're living, if you're incapacitated and you can't make decisions like that stroke or whatever might happen, you need someone to set medical directives, make those decisions for you, maybe financial directives. So really important that you address, and maybe let's review on a regular basis. Again, part of wealth management. Last, but certainly not least, is risk management. And it's interesting, I'll put a real general term on risk management. Risk management is protecting what you care about most, right? Yourself, your family, your home, your business, the things you work hard for and you love. So let's think about risk management and reward analysis. So risk reward analysis, one thing that we use in our practice is called Riskalyze. It looks like a speed limit sign. And basically what we're trying to do is align the risk that you're taking, the volatility, the risk you're taking with your investments, with the risk you're comfortable taking. And if you look at it from a speed limit, you don't want your portfolio driving faster than you're comfortable driving. All right. I'm a car guy, so I'll throw out car terms all day long. All right. Let's think about it. You want your auto insurance to complement your bigger picture. That might not be a place to save. You know, 1 in 10 drivers in Atlanta, Georgia, we're one of the worst in the United States, is under and uninsured. So we need to make sure we got proper coverage. Listen, you've worked hard, you've saved, you want to pass on. This is not the time to get too chintzy. You want to have uninsured motorists. You want to make sure those limits are where they need to be. Let's think about home values. Listen, lumber has gone up. Real estate values have gone up. Everything's gone up. You need to be talking to your insurance agent, or if you do it yourself, and figure out, hey, listen, you know, do I have replacement cost in place that will cover what today's replacement cost will be? I hope that makes sense. Because listen, it's going to cost you more today to replace that house than it did. So we want to make sure it's not about always the lowest cost. Remember, you're buying insurance to make you whole again, not profit from. So we want to make sure that replacement cost there. Life insurance, everything's going up. College cost, home cost, yard surface, everything's going up. Maybe look at your life insurance, health, long-term care. Long-term care is not going to go down. Listen, we're a nation that is aging, and more of us are going to need care. If we believe full-time care or assisted care or home care, it might be you just need someone to come and help you with your loved one so you can get out of the house and just take a deep breath, gather yourself. That's going to be a cost. Do you want to hold that cost, or do we want to pass on some or all that cost to an insuring company like an insurance company? Let's just be mindful of all these things. You own a business, really important. This is your life saving. This is your passion. We want to make sure you cover that. Listen, businesses, we have a commercial insurance company, insurance agents, everyone in-house, a legal team, accounting, and we often talk to our business owners and say, listen, your business is doing great. We got to make sure you're properly covered. We're going to make sure that machinery that you have is properly covered. Most importantly, that cost to replace that machinery is probably going up a lot. So, we want to think about all these coverages and where they play a role in our lives and what's important. Kind of wrapping it up. I know Stacy's going to give me the news here in a minute, but why is it important to have total wealth management? Why is it? Well, because we need to address each and every aspect of your life. You're not all about investments. You're not all about this retirement down the road. You want to pass on to the ones and things you care about. You want to make sure that what you worked hard is still going to be there, right? And that's risk management. In investments, that might be distribution analysis. It might be income and cash flow analysis. So it's really important to put that team. If it's someone like us, great. If you're working with us and you're on a call, you already know we do all this. If you don't, go talk to who you work with and ask them those tough questions. What can you do to ensure that I am getting total wealth management service? So basically, you're acquiring a comprehensive plan addressing all aspects of your financial lives. Stacy, they've heard me enough talking. Let's turn this over to some questions.
Okay. Well, thank you. Thank you so much for that informative information that you've given us. And I do have a couple of questions from the group. And the first one is, when should someone start thinking about investing? Is there a particular time in your life or in your career that should become a focus for you?
Well, definitely when you have, when you're in the major part of your career, or you're starting your career, you're starting cash flow, earnings, all that. But listen, you could start as soon as there's money that can be invested for you. It doesn't take much. I haven't looked at some recent numbers, but I think there was a number, if you're in your 20s and just $25 a month at a 6% return to 65 is going to get you over $1 million, right? It's the compounding money. It's time, right? It's just not how much you invest at one time. And we've also run some figures where we've seen lump sum investments, and then where someone else has come back and done maybe, maybe like a monthly investment after that. And we've seen almost sometimes the monthly investments outperform the lump sum investments. So I think it's time, not just making an investment. It's the time that you do it. So I think as early as you can should be the time.
Right. That makes sense. Well, another question is with regard to risk analysis and risk management. How do I know how risky I should be? Like, is it based on my age, or how do we quantify that?
I think this comes down to, good old fashioned asking questions, right? Let's look at it this way. If, and I can always talk about what we kind of do in our practice, but, risk analysis, and we'll do what's called risk lies, and it sets a speed limit number. And basically say, listen, in a 4 to 6 month period, if your portfolio is up 20%, you'd probably be happy. But if it goes down 10%, would you feel like you're going to make an emotional decision, all right, and try to make some changes? Because what we don't want is emotional decisions. We always want good business decisions. We also want to make sure that, if it goes down, it doesn't go down to a point that get you into what's called a negative sequence of turn if you're approaching that point where you're going to be drawing a good amount of funds from your savings, your investment account. So I think it's just every case is different. There's not a certain number that is right or wrong. We just got to find really what's right for that particular person in their personal goals and objectives. Everyone's a bit different. But I would generally say, of course, you want to be a bit more conservative as you get older than younger. But where do you go? If bond values are probably, in principle, going to be stymied and going down, then you got to go to equities. And if you go to equities, you're increasing volatility and risk. There are some strategies that we're employing to combat that, but that's something that I know is quite a conundrum out there.
Right. Okay, and here's one more for you. Should I put more emphasis on a specific area of wealth management than another when you can look at the total wealth management package and the different components? Is there anything that stands out?
Well, yes and no. I think, some are going to take more time and you're just going to have to monitor them more, right? Your investments, those, that changes a lot, right? It might change with the market's going to change with the economy. It's going to be cyclical, secular. Areas need to be adjusted. The diversification, individual equities need to be watched. So yeah, that's going to take more time, and probably your retirement planning, making sure you're on track, you're ready to hit the goals and objectives, the cash distributions, the income's going to be there to meet your vision of your retirement. So I'd probably say those two areas are probably the most, and then estate planning, risk management, and the taxes, that's going to pop up every year. So that might be taxes, investment, retirement, but I don't want to say risk management or estate planning isn't something that you don't need to be regularly looking at. It might be more on a 6 months to annual or a couple year basis with estate planning.
Right. Well, I think it's an individualized approach that's so important that you look at each client and what's important for them at their stage of life as well.
Yeah, absolutely.
Well, thank you. Okay, well, I would like to thank everyone for joining us again today. It's always a pleasure to have you join us for this Lunch and Learn each month. And thank you for your questions and for also staying up to date with us on our website and our weekly wrap-ups. Graham did mention that we have the Retirement Planning Today classes, and if that's something you have not checked out and are interested in doing so, please reach out to us. We actually have a class in August, and it's coming up really quick next week, so we might be able to get a few more participants in on that, but if not, then we have one in October, and we would love to sign you up for that if you're interested. So thanks again, and thank you, Graham. And I hope everyone has a great afternoon.
Thank y'all. Take care.
Bye.